We all understand that listed businesses provide a wide scope for earning across large, mid, and small companies. But how can one spot good businesses early on while they are still in the unlisted space? The mid market private equity space is growing because of rapidly expanding Indian economy. So the next panel will discuss the art and science of spotting multi-baggers amongst mid-stage unlisted business where the risk of failure is high. And let me now introduce you to our panelists. Our first panelist is Mr. Ashish Ahluwalia. Ashish joined Axis AMC in July 2022 as Director Private Equity to build and strengthen the firm's private equity and venture capital investing capabilities. He has over 2 decades of professional experience, of which 12 years have been in growth private equity and late stage venture investing. Prior to joining Axis AMC, he was the global co-head for equity investments in healthcare, food and agri, and consumer at CDC. Our next panelist is Mr. Perumal Srinivasan, who is the managing partner at Exponentia Capital Partners. He is one of the 3 founders that set up HSBC India Private Equity and raised a $60 million fund in 1995. Prior to joining Exponentia Capital, he was the managing director and head of Citigroup India Private Equity team. We also have Mr. Vikram Gupta. He is the founder and managing partner of Ivy Cap Ventures. His career spans over 30 years in private equity, venture capital, business consulting, M&A, strategy and operations in healthcare and life sciences, education, consumer, technology, and other industries. He has held leadership positions across various well-known companies in India and abroad. He received the Distinguished Alumnus Service Award from IIT Delhi in the year 2020 in presence of the Honorable Prime Minister of India. This session will be moderated by Ms. N. Mahalakshmi, a financial journalist of 25 plus years. It's an authoritative media voice. She is part of the senior leadership team at Network 18 and currently leads markets and economy coverage at Money Control. She was earlier the editor of Outlook Business and Outlook Profit magazines. And before that, the editor of Markets and Investing at Business Standard newspaper. Over to you, Ms. Mahalakshmi.
Thanks, Akriti. Indeed, it's an incredible opportunity to be moderating this discussion amongst such august people with so much experience in late stage investing. Ashish, Srinivasan, Vikram, thank you so much for agreeing to do this. Thank you, Kamal and PMS AIF for organizing this event and inviting me here. The topic itself is super interesting, the art and science of spotting multi-baggers among mid-stage unlisted businesses with high risk of failure. Now, this sounds like a theme which has multiple parts, and I want to just decode this topic itself into 3 parts. One, of course, there is no doubt we're talking about mid-stage unlisted businesses, but the first part is spotting multi-baggers, and I'm going to start with an opening question with that. First of all, does late stage investing or mid-market stage investing offer opportunities for multi-baggers at all? I ask this only because in the last 10 years or so, as we've had such an avalanche of money flowing into the markets, there has been a stampede for good companies and businesses. And in some sense, at every level you see, whether it is public markets or late stage or mid stage or venture, everything has gone back 1 notch in terms of returns. So what if you assumed you would do about 12-15% return if you bought into an IPO in the public markets, today you have to pair your expectations. Similarly, if you were to get into late stage, you have to pair your expectations because it's all ramped up already. In mid stage, again, your expectations are lower. So first question is, what is the opportunity size for picking multi-baggers at the late stage? Srinivasan?
No, I think the opportunity is huge. I don't agree with you that it's difficult or it's impossible to find multi-baggers. We think that the market opportunity is interesting, and we have been able to create multi-bagger investments in our Fund 1. And we are currently deploying our Fund 2, and we do see interesting opportunities. See, multi-bagger means many things for many people. So I will start with that. If you look at the textbook definition, anything about 2x is a multi-bagger. And I'm sure people are not just looking for 2x. We try to target 3 to 5x is what we try to make when we make investments. And that is the filtering criteria for us, that there has to be sufficient amount of profit growth during the holding period that we have for the investment. And there should be an opportunity for multiple expansion during the holding period. So if you get both, then there is every chance that you can make 2.5, 3 times your money in the investment. And that's what we look for. And I think that is what investors in AIFs are expecting. And they have right to expect that. And we see opportunities to be able to deliver that.
So you're saying 2 to 3 times over what time period?
Look, as I said, 3 to 5 times in 3 to 5 years is what we talk about in terms of underwriting. But there will be the odd deal which will not make the sufficient return that you want, and there will be an odd deal which will make 5 times. So on a blended basis, the fund should make 2.5, 3 times. Whereas the underwriting criteria for any deal that we like to invest in is that we should believe that there is a high probability that we can make 3 to 5 times in 3 to 5 years. That is the way we look at evaluating transactions. And let me put it like this: there is more fish to fry than I'm able to find and invest.
Fair enough. Is that the same case with you, Vikram?
So let's first of all understand the bigger picture here. If you look at the India economy over the next 25 years, and even if you just took a mathematical way of estimating how much the GDP can grow to, just an 8.5% average annual growth for the next 25 years will lead to a $25 trillion economy. Today, we are about $3.5 trillion. We are talking about adding another $20 to $22 trillion in the Indian economy. And a lot of that, we believe, is going to come from what is happening today in the startup ecosystem. And so the whole idea is that if you pick the right winners and back them and support them properly, you will create huge companies. If you look at the last 10 to 15 years, there are quite a few companies that were very, very small companies. You've seen IPOs like Nykaa, Policy Bazaar happening, and about 10 years ago, these companies were very small. And today, you've seen that the valuation is going substantially large. Even in our portfolio, we would have invested in companies like Purple, Clovia. Purple, we invested 15 crores in 2015. The stake that we sold for 330 crores in just 5.5 years. We created a 22x in our portfolio, giving us return of more than 1x of the entire fund, calling it as a dragon in a portfolio. So we actually focus on building dragons in the portfolio rather than just unicorns. I think this phenomena is going to continue. We're going to continue seeing more and more dragons building in venture capital, private equity portfolios. Therefore, you will see multi-baggers happening more and more across sectors. I think it's a matter of picking the right winners. Of course, certain sectors will be timed specifically in certain years. For example, we believe that this year is a good year for investing in agri-tech as a huge area. Consumer tech continues to be exciting. And then, of course, there are opportunities in SaaS, which is related to artificial intelligence, IoT, machine learning, and even other tech areas which are becoming hotter and hotter. So we are very excited to be investing in this current scenario.
So, sure, fair enough. So that is sorted. The opportunity size is huge, and it's really up to us to pick up the multi-baggers. So The next part of the topic is high risk of failure. Let me come to Ashish for that. Ashish, do you really think at mid stage, late stage, you still have to contend with high risk of failure?
Thanks, Mahalakshmi. Well, it really depends on the
strategy that one is playing. And I think from what Vikram and PRS said, you could see that there are sort of slightly different stages that they're investing in, right? And we're probably slightly late stage. The risk of failure is obviously higher when you're going early stage. And that's probably what Vikram's fund is doing. And, there it's a different strategy to diversify. But some investments really, you hit home runs with them. And that leads to an overall portfolio return. I think our strategy is similar to what PRS was highlighting, where we go in slightly late stage. We're not taking binary risks on businesses disappearing, right? So we're going beyond the stage where product market fit is done, customer cohorts have started forming, there is acceptance of the product, and this is late stage venture growth capital. So that really comes down to risk assessment manager or a particular fund. I think the fact that various strategies work in this market. It's then about investor balancing their sort of risk reward equation with the strategy they're playing. I think we're in the same sort of bucket where we're minimizing risk of loss, we're minimizing risk of failure, but we're also targeting modest return. Now, modest is relative. Look, any business in India, Indian GDP is going to grow at 6 to 7%, and that's real GDP. And you add you convert that to nominal terms and you're talking about 14 to 15%. So any investor should give you that return. And then when you're trying to get top of line companies, you add premium to that, you get to about 18%. And then you add alpha creation, and obviously our investors are expecting more than 20 or between 20 to 25%. That's what we're targeting. And the late stage has continuously shown that there's the ability to generate those kind of IRRs meaningfully for our investors. With minimal risk of loss of capital.
Sure. So let's just dive into this whole process of picking multi-baggers. So Vikram, take us through your hygiene check when you sort of start picking, because you're amongst these the three of you. You start the earliest. So what is your checklist really like?
So we start at Series A. By Series A, what we mean is your first institutional check. And at that time, these entrepreneurs have already raised some form of seed funding, sometimes even pre-Series A funding. And there is some kind of product market fit which is already established. There are revenues which are justifying the unit economics, and therefore scale potential, etc., can be tested in terms of the business model itself. But the fundamental check for us starts with the check on the team. So we first like to understand, are we investing in the right team combined with the right target of the space? The space defines, the size of the opportunity and which are the other players in that market. Is there enough opportunity for somebody to really create a huge business in that space? And combined with a very high quality team, which is majority of our focus area in terms of understanding the passion, the risk they are taking, and what's the motivation they have, who are the key players in the team, and how much risk reward is distributed amongst each one of those, and over and above, how they are aligning themselves when it comes to the roles and responsibilities, because I think that becomes very fundamental from the overall execution of the plan is concerned. So this is the first checkpoint that we look at. Then, of course, we also look at what kind of value we can add to what they are doing. So, of course, we look for gaps early on, and where all Ivy Cap can bring in a lot of value. We have created this mentor trust with lots of mentors who can fill these gaps. We also try and understand the team gaps. If they are missing a CTO or if they are missing a a marketing person or a technology person. We try to help them bridge that gap. So, after doing all these checks, we look at the detailing of their business plan and the projections, and try to understand how optimistic and realistic those are, and is the capital they're raising enough, and will they hit profitability by a certain time frame, because the stage at which we invest, they may not necessarily be profitable at the EBITDA level, even though at the gross margin level and the contribution margin level, they might be profitable. But at EBITDA level, majority of the cases, they are not profitable. So we try to understand what stage and with what amount of capital they'll be profitable. And the other filter that we apply which is very important for us, is the capital efficiency mindset, which is very common across our portfolio. We might invest in a number 2 player as compared to number 1 player in the market, if we see that number 2 player is much more capital efficient as compared to number 1. So at some point, the number 2 will overtake number 1 because of the capital efficiency. So these are some of the factors that we look at the time of investing.
Okay, I want to come a few of these points, especially as you're talking about, contribution margin, EBITDA margin. I see even in public markets, some of these new age companies are struggling to get to that level. And you're saying 3 notches below that, you're already looking at these parameters. I'll come to that. But before that, your checklist, Srinivasan.
Look, typically the companies that we invest in have 10-15 crore positive EBITDA. So there is a proof of concept, there is a acceptance of the product in the market, and we know that the business model is working, right? And we could be a second or third investor in the company, but we also find often that we are looking at transactions where the promoters funded it to that stage, and we are actually the first investor who invests. So, like I said, first proof of concept, easy test is there is EBITDA. Sometimes we also do transactions where the EBITDA is not there, but we believe proof of concept is there. Okay. And only when we think there is proof of concept, we get involved in a transaction. That is number 1. Second criteria is that we generally tend to work only with first generation entrepreneurs. Khandani raised businessmen are not likely to be my candidate. Okay.
That I think is universal, right? Khandani Rahis will anyway funded by themselves to a large extent.
Yes, sir. But anyway, so the point I'm trying to make is that more than whether he is self-funding, I think we are looking for people who have the mindset of going where the value is. Because we are not very comfortable that we will create a portfolio where the exit is predominantly driven by IPOs. Okay, I've been in this business for 30 years. Mahalakshmi started in 1992 in TDICI. I don't even know whether people recognize TDICI as a name, but ICICI Ventures once upon a time was called TDICI.
Yeah.
Okay. But in this last 30 years, maybe 10 years, the IPO market has opened. Okay. 20 years, we couldn't do an IPO even if you, whatever you did. Okay. So our idea is that, we should be working with entrepreneurs who will be equally excited about a M&A transaction as they are about an IPO transaction. It's very unlikely that I'll find that I will only find that in the first generation entrepreneur. So first generation entrepreneur, but most importantly, the mindset that, he wants to create value. He also wants to sell some part of his shareholding and make money. Okay. He wants to make capital gain. I think that is the second important criteria for me. And I should be able to figure out, basically he's got one big deal in his mind. Okay. 5 years later, he wants that big deal. Okay. And I want to help him get there. And when he is doing that big deal, I'm also exiting from the firm. Whether that big deal is an IPO or a M&A transaction, only, that will depend on what has happened to the business, what is happening in the economy, what is happening in the stock market, where better value is being realized. Sometimes the IPO markets are more valuable. Sometimes there is better value in the M&A transaction. And whichever way it goes, we want to work with the entrepreneur to get there. For me, that is a very important filtering criteria.
So before you enter, you want to see multiple exits. Multiple
exit avenues. I'm saying the guy should have the open mindset that he's thinking not like, whichever way it goes. Yeah. If he tells me that, look, I have to do an IPO, and if IPO market is shut, tough luck, you'll have to sit there and wait for 7 years, 8 years. then we can't work like that.
Sure, sure.
We have a 5-year hold and we want to return money to our investors. And our investors don't look at what is the value of the portfolio. They want to know how much cash we're returning. DPI is something they are very focused on at our stage of investing. Okay, so in our fund one, it's a 4.5-year-old fund. We have 90% DPI. Okay, and I think that's an exceptional number. When I meet my investors now, I tell them that don't expect that in fund two. I'll probably give you 30-40% before I come for fund three. Okay. But I think we have a very razor sharp focus on making sure that we are investing in exitable transactions. I think that's a big criteria for us. The third criteria is that, we want to assess that the company can actually get to 7,500 crore EBITDA, where, M&A transactions are possible, IPO transactions are possible. Okay. I don't want to have journalists asking me about contribution margins and EBITDA margins when my companies go public. Okay. So to profitability in the investments that we make. Okay. Our exit valuations are traditional metrics. EV by EBITDA, PE multiple, book value multiple. Okay. Maybe at entry, I will have them. Maybe at entry, I will not have them. But exits definitely will be based on traditional value metrics. I think is the final clinching point for me to get serious about a deal.
Sure. That's very helpful. So start to see EBITDA right up front, or at least look at EBITDA and traditional multiples by the end of your term. And second thing you said was multiple exit options, not just IPO, multiple routes. Fair enough. Ashish, your checklist.
Very little to add to what Vikram and PRS have already said. Look, Malakshmi, there are frameworks and there are frameworks. We use multiple, but I think for us, and given the stage, we're looking at market, product, and team. It's quite simple. In market, we like market structures which will turn into monopolies or quasi-monopolies or oligopolies. I think evidence internationally in India has shown that, largest profit pools tend to get created when that's happening. So, whether, we've gone into food delivery or we've gone into spaces in D2C consumer, we've gone into healthcare. I think, that's a very important lens. And there's an important bit there about, target addressable market and monopolies. I think people who show signs that they are being very successful in certain smaller target markets and then start expanding the market, we like that versus, people who talk about global domination on day zero. So I think proof of execution versus your market, very important. Product, I think adequately covered, right, in terms of either serviceability or a cost advantage or a definite advantage to the customer. And team, I think both Vikram PRS spoke in detail, right? Typically, especially in the new age world, we do both new age and traditional businesses. It's a group of founders. We're looking at complementary skill sets. I think that's quite important for us. We're looking at teams who are open to identify gaps in skill because, these are companies which are growing very rapidly. When you're trying to grow at 40-50% year on year, there has to be that acceptance of what you don't have and the ability to add that to your team. So I think, market, product, more the science, team, more the art.
Sure. Fair enough. 2-3 things you talked about the theme. The first thing is, so by market structure, you mean that you need to see a company gravitate from one market structure to another, which is more consolidated, right? From a perfect competition to an oligopoly to a monopoly. Is that what you're looking for?
Well, we're looking for that. And there are two things here. I think one is, we're looking, and this goes back to your point about economics and EBITDA, right? So often, we'll find that high growth companies at an EBITDA level are negative, but you've got to double click and see that the markets that they started first with, are they profitable in those markets? Are those customer cohorts performing, right? Because as you go into newer markets, you may be burning money, but if you proven in some select markets where you went first that yes, this combination of product team is working for your P&L, I think that's what we tend to double click into, and that, that's where a lot of our sort of analysis goes into. We call it burn to win ratio. And there are sort of all sorts of jargon around that. So that's one bit. And I think the second is simple barriers to entry, right? So I mean, look, we've gone into Lenskart, for example, right, where it's clearly Lenskart Titan, extremely high barriers for a third player to come and get to that scale, right? Or food delivery, right? It's sort of a duopoly between Swiggy and Zomato. Can a third player come in? Yes. It's going to take a lot of hard work and lots of millions of dollars. So, and the same things happened with mobility. The same things happened in a few other sectors, and we like market structures which are moving in that direction.
Fair enough. So the second point you talked about was total addressable market, and I think this is going to sort of open up a fairly wild discussion, because I think if you look at the last 4 or 5 years and how we're seeing things play out in the stock markets, and I'll take the example of Nykaa, the way it was priced. Essentially, you prove yourself in one market that's like a perfect recipe for success, to another market where there is already an established leader. But we try to sort of position that in a way or value it in a way that you look at the total addressable market as 1 + 2, but the way the company was able to capture 1 is probably not the way it's going to be able to capture 2. So how do you really look at the potential risk as well as the reward when companies move from, let's say, one market to another? You talked about, you said, you should have established in one market or one region, and then we look at expansion into other regions. And it might be a very different story. For example, DMart may be very successful in one region. There are regions where they have not been as successful. And the second part is when you move from one domain or vertical into another, for example, from beauty to fashion, there is a certain assumption that the management is competent and should be able to pull off, but then the market itself is probably, the dynamics of the market themselves may be very different, whether it is regional or vertical. So how do you look at potential risk and reward when you look at this whole thing? Vikram?
So we typically look at a 2x2 metric of product and customer fit, right? So on the product side, we talk about existing products and new products or services. On the customer side, same thing, existing customers and new customers, especially when you're talking about your expansion strategy, right? So if you're talking about existing products in existing markets, there you're talking about, can you penetrate deeper? Can you acquire bigger market with your can you, basically get better profits? So, that's what you look at when you're looking at existing product in the existing markets. Then you have your new products in your existing markets. If you have your existing customers who are already liking your way of servicing your products, the channels you're using, you already have them, you don't have any customer acquisition costs. There are adjacent products that you can add, which is a lower hanging fruit for you. You can add, for example, you mentioned from beauty products to fashion products. If you've already acquired these customers, your customer acquisition cost is hardly anything. You just need to add those new products in such a way that you already know their preferences, you already know where they are, what kind of products they like. So it's easier to also sell those products to them. Then there is existing products to new customers. Now, you may have acquired certain customers. For example, you may be only in metros and you want to now tap in tier 2, tier 3 towns. There, that, your strategy has worked for this particular segment. Then you tend to look at what else will work for those new customer segments. And then finally, there is new products for new customer segments, which is very hard to do. And when people try to do that, they reach that stage only once they have tried the other 3 things and they've reached a scale. Otherwise, you may be trying to do too many things at the same time, and you may not have the right bandwidth, and you may end up failing in most of those things. So I think that's the way we look at things. And we've seen companies do these stage process very successfully, especially if they have the right technology platforms to understand the consumer very well. Purple did it very well by understanding the consumer persona. Quite a few portfolio companies have been doing it now. So that's the approach people follow to tap into the markets.
Sure. Srinivasan, when you forecast growth, how do you look at this? You know, there is some part, obviously, you're assuming that the management will be able to grow it in X way, but there are multiple variables. The competition intensity may change. The markets that you go into may be very different and growth may not pan out exactly the same way. If you're looking at different categories, it could be they could play out. Again, I'm not very sure. First of all, do you agree that, you know, if you have got, especially in digital, if you've got a set of customers, it's easy to cross sell? Because for the examples that we've seen, it doesn't seem that easy.
Well, Citigroup was formed. I mean, I'm an ex-Citi banker, so Citigroup was formed because they thought, you know, financial products, we will be like a consolidated marketplace, and all kinds of financial products. We will do cross-selling and all that. And the Travelers merger really didn't work. So finally, they spun it off. I agree with you. I mean, cross-sell is not a linchpin on which I will hang my thesis. Okay. Look, what are the things that, you know, perhaps I should have highlighted when we talked earlier, and that will give you an idea of our approach, is that, you know, we look for situations where marginal profitability is higher than historic profitability. So what I mean is that, you know, look, the overheads that a company builds are actually investments in continuing to be able to service your customer. Now you have built the overheads, okay, and let's say you have 100 crores of revenues and you have 10, 12 crores of EBITDA. But the next 100 crores of revenue is not going to give you 12 crores of EBITDA. It's going to give you 30 crores of EBITDA. Okay, because the growth in overheads and growth in costs of servicing is not going to increase that much. The marginal profitability will start falling more and more directly into the EBITDA line. Okay? So we really look for situations like that. Okay, because if you are talking about cross-selling or going into a new geography or a new product line, effectively you are a startup in that line of business. I don't take startup risks. Okay, something is working and I try to help the company scale from 15 crore EBITDA to 75 crore EBITDA. Okay, if they have to go and do something completely new to get to that 75 crore number, then that is not the, that is still, you know, involves venture and early stage risks. Okay, so we are very particular that, you know, rinse and repeat is what we're really looking for. Okay.
Fair enough.
What they need is capital to get to where they have to get. Okay, they need money for working capital. Maybe they need to set up a little more capacity. Okay, so those are the kind of situations that we get involved. Okay, and we really avoid having to, you know, shall we say, discover the wheel.
Sure. So Ashish, a question on TAM again. For example, yesterday I was just looking at Zomato results. Of course, now it's in the public space, but not very long ago it was in the private space. And they said, of course, now there is a great realization amongst public listed, new age public listed companies that they have to demonstrate a path to profitability. And they seem to be well on their path. At least the management seems to be walking the talk. But I saw that the way they have done it is, this quarter, they have pulled off or cut down from 333 cities where they had expanded in. Now, obviously, to demonstrate profitability, you're cutting back on growth, and something you thought, and that would have perhaps added to the total addressable market itself when you did a DCF or something when you were valuing the company. How do you account for an optimistic, realistic scenario, or how do you really look at valuations? And what is the right TAM to really look at to benchmark your valuations?
It's a large question, Mahalakshmi. We could take a session on TAM. But, you know, experience has taught us, and especially at this late stage that we're coming in, if the product is working, and companies which have successful products are generally more conservative about their TAM. Where the products has got certain issues, we generally find that people are talking up the TAM. So, you know, that's a rule of thumb that's helped us. Look, food delivery is an interesting example, right? Where, I mean, look, theoretically, everyone who eats and has a cell phone is TAM. Okay. But if you then sort of go deeper and, you know, get into the metrics of this business, you know, you could break this business down into 6 metrics, right? It's about number of people ordering. It's about average order value, which, you know, seems to have settled between 400 to 450 rupees. The third is the take rate, which, you know, the food delivery apps make, which is, let's say, 26, 28%. This is public knowledge because the company is listed. And then it's about the cost of delivering that order, right? These are sort of the essential metrics. Now, you know, the metro cities will have more affluent people, so AOVs will be higher. You will run denser routes, so your cost of delivery will be lower. But they'd be reaching, you know, slightly modest growth rates because you obviously exploited these markets. The tier 2 and tier 3 markets will have lower AOVs. So you'll have to invest more. You will run less dense routes. So contrary to maybe just intuition, your cost of delivery may be higher. And I think, you know, some of these companies have just superb data analytic capabilities, right? Another thing that we're sort of looking at. And so, you know, you double click on all of these, you realize that, look, if you've got, you know, I think there are clearly learnings in terms of growth versus profitability in tier 2 and especially tier 3 markets. You know, you will have to see just, you know, longer paths to break even and longer paths to profitability. And then you have to tie it into your cost of capital, right? I mean, when 21, 22, cost of capital was different and you could take more aggressive bets to grow into these markets. Today, the priorities are different. Does that change the fundamentals of the business? No. I think these are different levers that they're pulling, and that's coming through data and just understanding of these markets, companies like this to get to profitability faster. And add to that, you know, I completely agree with what PRS said, right? So it's the core business which needs to fire. We can't, and we don't as investors hang our hat on adjacencies, right? So any business like this, you know, an extension is, look, you know, we're delivering food, we want to own cloud kitchens, right? So, okay, there's cloud kitchens. You know, most of our delivery fleet is more occupied during lunch and dinner. Why don't they deliver groceries in the middle? Now, I think the trap we like not to fall into, and it's easier said than done, is how much value are you ascribing to the core business versus these adjacencies, right? And the more you fall into adjacencies, I think those are traps which we understand. They all start firing once the core business is profitable. So it's the balance that sort of we need to be aware of.
Fair enough. So quickly, we'll just sort of wind this conversation with some real tips to picking up multi-baggers. So Vikram, 3 most important things to ensure that, you know, you maximize the chances of success in your bets.
I think you have to be in a sector where you know, the technology can differentiate the business and then the scale can happen much faster. And therefore, a highly capital efficient model has to be there. Of course, team is the core of creating a very large business. With execution is the key in any business, and execution is all about the team. And the third is, of course, you know, the space and the TAM that we are discussing here. You know, and within that, unless you have a highly differentiated business model, you will not be able to scale. So differentiation is the key in that market. Even if you know, you'll always have competition if there is a need and the market is large. But if your business is differentiated, you will create scale.
Okay. PRS?
Look, we are not unicorn hunters, okay? So we are trying to make 3 to 5x. I told you I've been in the business for 30 years. I've probably done about 60 transactions. And maybe 2 transactions I did more than 10x, and 1 transaction I did more than 25x. So out of 60, you know, getting multi-baggers above 10x is not a frequent occurrence. Okay, so we are looking for margin of safety. We want to focus on making 3 to 5 times, and we want to keep our DPI and keep our investors happy. So that's what our approach is focused on, and we are looking for, you know, first generation entrepreneurs who are exit agnostic, who will work with us. I mean, I admire the entrepreneur investing, but I also want to have some reciprocal admiration from the entrepreneur towards us. I've been at it for 30 years. So if he doesn't admire me, or he doesn't, you know, admire my colleague, he should say that, okay, you know, like DJ, I want to do a deal with him. I will make some compromises to make a deal happen. Only when you are in that kind of a framework, we try to do transactions.
Yes, the promoters must demonstrate love by giving you price discounts.
Yeah, I would think so. I mean, and I see at the end of the day, we have an experienced hand on the table, and I'm sure they will see the value in having, the experienced investor working along with them. And if the guy is not smart enough to realize that, that value, and he's just saying, I'm going to go with the guy who's paying the highest price, then we let it go. As I told you, there's a lot of fish to fry.
Sure. Ashish, your no compromise criteria to pick multibaggers.
I think no compromise on depth of research, whether it's ourselves or even for people who are listening, if you're choosing investment manager, depth of research by far. I think in the investor community, the ability to add value to your companies and generate greater return, extremely important. And exitability, I think, don't lose money and find an exit. You may be sitting on multi-baggers, but if they're not exitable. So I think that's the holy grail for us. And we want the love of our investors. I think that's also the holy grail for us. If we make money for them, we get their love, we're happy.
Sure. That's all we have time for. Thank you so much, gentlemen. It was a wonderful, engaging discussion for me. I hope our viewers liked it too. Thank you.
Thanks, Mahalakshmi.
Thank you.
Over to you,
Well,
Akriti.
I'm certain that the viewers really liked it. That was a thought-provoking session. Thank you so much, Ms. Mahalakshmi and our esteemed panelists.